In a study on 5.2 million Fidelity accounts, women outperform men by 0.4%. This study, it covered 10 years of self-directed accounts. And less than 0.5%, it might not sound like much, but it compounds. For an example, here's investing $500 a month or $6,000 a year. One account grows at 8%, while the other account grows at 8.4%. And looking at it another way, here's the difference in returns over time. By year 35, you'd have close to an extra $100,000. The little numbers, these really compound and make a big difference as the years go by. And it's really just a conservative example. If I adjusted for inflation in the years ahead, it'd be even higher. Investing $6,000 in a year is also less than the IRA contribution limit of $7,000 for 2025. Also, it's well below the annual 401k limit of $23,500. If you could max out your contributions, a difference of 0.4%, it could come close to the difference of making an extra $1 million for your retirement. To get a better understanding of compound growth, I'm going to link to a video at the end and add some resources in the description. This is a really powerful cross-disciplinary concept. It overlaps with biology, computer science, and many other fields. But why do women outperform men at investing? This difference in returns, it largely comes from investing behavior. On average, women tend to take a more passive approach. They trade less often, and this ends up saving them in fees, and they make fewer mistakes. Day trading, swing trading, they are exciting. You can really learn a lot about the mechanics of markets. But countless studies have shown that a buy and hold approach, it outperforms. One big downside has diminished over the years, but this has also given way for more mistakes. In 1980, it cost about $35 to place just one stock order, either a buy or a sell order. If you only had $100 to invest, you'd instantly be down 35%. And inflation adjusted, a $35 trading fee from 1980, it's about $143 today. As technology has marched on, barriers to entry for investing, they've never been lower. Trading fees are $0 now on most platforms. And did you know Robinhood actually pushed the entire brokerage industry to lower fees? However, this has really led to more trading activity, and most investors, they still overlook the implicit trading costs. Even with $0 trading fees today, short-term trading is actually worse than a zero-sum game. This is something that a lot of investors tend to miss, especially starting out. For every buyer, there's a seller on the other end of the trade. You're not putting new money into the business. Instead, you're buying existing ownership in that business from the seller. That alone is zero-sum. But to make matters worse, market makers, they still come out ahead. For providing liquidity, they'll profit between that bid-ask spread. There's slippage costs and other hidden fees to trading as well. On top of that, average investors are up against savvy, well-funded hedge funds. They're spending millions of dollars to get very subtle trading advantages, sometimes measured in milliseconds. They're stacked with PhDs in physics, mathematics, and computer science. That's who you're up against as a short-term trader. And this really just plays into the biggest reason that women outperform men in investing. I guess you could kind of call it a mirror test for investors. When it comes to investing, you're usually your own worst enemy. Over millions of years, we've become fine-tuned biological machines. We've really developed to survive the natural world. In the stock market, it's not natural. Here's just a small sampling of psychological pitfalls that we all fall prey to. Overconfidence bias, recency bias, herd mentality, confirmation bias, loss aversion, hindsight bias, and the list goes on. Are you familiar with all those? I double majored in finance and accounting as well as passed the CFA exams. The base study material for those exams was 6,000 pages, and those were not easy reading pages either. However, what I've really found to be more valuable over the years are books on psychology. By trading less often, you can simply avoid a lot of these mistakes, and that overall should boost your long-term returns. Women are better investors by simply trading less. Now, you might not want to throw like a girl, but please do consider investing like a girl. It's a different ball game altogether. And if you have any questions or comments, I'd really appreciate them if you drop them down below. And as always, I'd appreciate it if you tap the like button as well as subscribe. I hope to see you again soon.